Welcome into this lesson. In this lesson, we are looking at the gold versus the US dollar chart. And I hope that in the strategy that you have been able to go through the preparation lessons that are able to prepare you to be able to now come into the chart, because we cannot just come blindly into this strategy without being prepared to know what we are looking for and also the technical and fundamental parts of understanding the whole idea behind the gold and the dollar. So in this lesson, we'll be looking at the fair value gap in the daily chart. First of all, we have determined that the gold, we can see that the gold has been just bullish for a long time, and as we all know that the gold dollar is the gold pair is a buy market. So as a buy market, I'm not advising for every time you go into the charts to always buy. But what I'm advocating for is to understand the market structure first, but knowing that in most instances, as we look for the past years, we can see like almost the past 5 years, or even 10 years, the gold has been just a bullish market. And in a way, it's classified as the safe haven pair, since it's always in a trend. So in rare cases, will you see it in a bullish, bearish move? So it's just rare cases, but it's also confirmed by breaking structure. But in most cases, or in most scenarios, the gold is a bullish market. So for the analysis, we see higher time frame, the gold has been just buying since December 2024. So the market structure has made a shift to bullish. So this is a market where essentially you want to search for any order blocks or any fair value gaps, which will be able to make you be in sync with the pair or the market structure. So I have outlined this imbalance here in the daily chart. So we created this imbalance at this particular point on the 19th of March 2025, and we are yet to retrace back into it. So the whole idea behind this strategy is using the daily fair value gap to get in sync with higher time frame depending on the order flow, and also to find our setups, which now from there on we'll be able to look at how are you able to enter, to make your entry, where you should place your stop loss, and also your exit point in the gold market. But in most instances, we find that the gold is always buying. Most time it's buying. So in rare cases, we do see it selling, but it does sell. Yeah. So with this imbalance, we want to confirm that the order flow will respect this imbalance here. And from the daily chart, we see that once this imbalance was confirmed, we got a retracement down into this imbalance, and we see clearly that this imbalance was filled here. So once it was filled, how do we align ourselves with the order flow, or how do we now get our setups from there? So directly we'll go into the 1 hour chart. So this is, you can see that this is the 21st March 2025 when we hit this imbalance. So we'll go directly into the 1 hour chart on the 21st of March 2025. So what we'll be looking for next is a break in structure to confirm that this imbalance is confirming bullishness. So on Friday, we got a drive or a move into the imbalance. We filled it, and remember also on Fridays when we ran stops, we ran sell stops inside this imbalance. So what we are looking for is any break in structure. So once Friday closed, or once we printed here, what we'd be looking for is any break in structure. So the first break in structure would have been here. So we'd be looking at this as the break in structure. But remember, we just have to go with what the market has printed. So we see that the movements from here towards this break in structure, it is so sluggish. But what we want to see is a dynamic move, a move moving away further from and quickly towards this break in structure. Also what we want to see is any imbalances being created as we are moving towards the break in structure. So that is what ideally we want to see. So we see a consolidation inside this imbalance. The market consolidated here, and once we ran back on this new week, we started a new week, and the market ran back into this imbalance again, considering we did not run these lows. But remember, there was no need to run these lows for Friday, since this Friday's low was used to run previous weeks and previous days low. So on Monday, we ran some form of sell side liquidity. So another thing in this strategy is that once we hit this imbalance, we want some form of sell side liquidity being run here. Then any break in market structure. So we identify that on Monday we had a confirmed break in structure, because this now here, this high is a swing high. Why is it a swing high? Because we have a high which is lower than this high on to the left and also to the right. So now this ideally, once we run these sell stops here, this ideally is what we would want to see as our break in market structure here. So from there, did we get any break in structure? Yes, we confirmed a close above this swing high with this candle on Tuesday here. So what the next step is, we want our entry should be on the breaker. Remember that we've talked about the breaker and what is a breaker. A breaker is, in this scenario, since this is a bullish breaker, it's the last. Now here it's this up close candle before any bearish move. So this down close candle was created, and then we got a run again to run stops, and then we confirmed this now movement away from this high. So once this was confirmed as our breaker, remember we can use different entry, and I'll be able to teach these different entry points that you can use. So the first entry that you can use is the breaker, and you just have to extend it. But remember, I've said that we have to confirm the break in market structure first before even using that breaker. And the next thing is our entry should be during a specific time zone. So this time should be the time in which we get back into this breaker should be during session. So this should be in during the either the London or the New York. I prefer the London or the New York session. Yeah, and the stop loss should be below this low of the breaker of this up close candle. So yeah, and the entry should be at the high of this breaker. So the next entry point you can use is any fair value gap created where we were moving away to break market structure, and this is the imbalance. So this fair value gap used or created is what we want to capitalize on by entering during a specific time session. So the London or the New York again, and then you place your stop loss below the swing low of that fair value gap. For targeting, I'll be able to show you where you to target for both the breaker and the fair value gap. Also, if you're using the order block, we can see that or a high probability order block is any order block that is confirmed, that confirms a change in state of delivery being backed up by any imbalance. For example, here we see a change in state of delivery being confirmed by an imbalance, because this shows a dynamic move, and this shows that the order flow has resumed to now the new order flow that you are looking for. So this imbalance again is what we use as an entry for the order block, or sometimes we may get a run into this fair value gap or into this order block, but sometimes we may get that it may not hit this order block. Again, we have these two dynamic fair value gaps, two dynamic candles, these two don't close candles, so these two are the order block. So we use the bodies of the two and place the stop loss at the low of that swing low. So another thing for any continuation of the price or the order flow is that we can use, you see that we created a new order block here, but remember you have to be time specific in these session zones. So once we confirm this new order block, did we get any retest during session zone? Yes, we got here at the New York session. So once this has been confirmed, what essentially I want to see is the market structure is supporting, the order flow is being supported by the market structure. Yeah. So we see that with this imbalance here, we just consolidated till the next day, and then afterwards we got a movement away from this daily fair value gap. So where should you target for both the breaker and the fair value gap and the order block as your entry points? Where should your target be? So remember, this is the gold pair, and we are looking at the gold pair to be a buy market, or the gold pair is a buy market. So any swing highs or weekly highs are good targets for us to use as the targets. But another thing we can do is we can use the fib tool to target. So we anchor on the breaker. So I can see this higher, this one is another breaker here. So we can use from the swing high to the swing low, we just anchor the fib, and then the movement made from this point 1 to point 0 is what we want to multiply onto the, we want like a measure of it, the same movement from here to here. So if it's about how many ticks, however ticks it may be, from this one point, from this area 1 to 0, however ticks it will be, you want the same measure upwards, or even twice, or even thrice. That's where the market will be seeking to or will be seeking to exit, but also depending on the liquidity that is available high up in the market. So we see that also this here is also a breaking structure. Once we confirmed this run above with bodies, this is our breaking structure, and also this is our breaker. We see how well we got a retest back into this high. So the breaker is this down up close candle here, up close candle with the stop loss just below the body of this candle. And the retests, we got a move here at the session zone 9. But remember, you can use limit order. If you are using the limit order, you place you add spread. So just do not enter at that specific high. Enter above the market, and then we target towards this liquidity, coupled with now the measure of this fib tool, the fib tool that we used. So we see that the measure from this ticks from this high to this low. So it went once and twice and thrice. So we see how specific to the point we were to hitting the this fourth point in the fib tool here. So that's how you can use the fib tool for your targeting tool here. So that's it for this lesson, but we'll look into more examples in the future lessons. But remember, the steps that we have taken is, first you have to have a daily imbalance of the fair value gap, then evidence of run on sell stops. So if we're in a bullish market, it's sell stops being run, but if we would have been in a bearish market, it would be sell buy stops or buy side liquidity. So sell stops, then a breaking structure, then a retest, and then a retest coupled with fair value gaps. So these fair value gaps support should show support of higher time frame order flow. And also remember, at the retest we enter during specific time sessions, and these sessions are the London and the New York. Then you wait for the market to deliver. So that's it for this lesson, and I wish you all the best in your trading.